Hey, good afternoon. Tina, you're going to have to mute your sound because I'm hearing the echo. Hi, good afternoon. My name's Lee Fletcher, and this is Pivoting to Recovery. This is the fourth of this series that I've been talking about things related to how to respond to COVID in your business. Let's see. This is me, and I'm a founder of a law firm, and I'm co-founder of Rising Tide Innovation in downtown St. Petersburg, Florida. We're a co-working space that is designed to help entrepreneurs create the network and get the resources they need to grow their businesses. I'm also a small business owner in the Caribbean, and so my beginning of the Pivoting series was really kind of sharing with other people my experiences as I went down the path of trying to figure out how to respond to COVID-19 and what to do for my business given all the things that were happening at the federal and state level. This presentation is being recorded. Typically, when we post it on YouTube, we don't include the Q&A section. So if you don't want your question or your voice heard on a recorded YouTube, ask your question at the end. If you don't care, we're a small group, so definitely ask it whenever you want to. So this time I'm going to be talking particularly about the PPP forgiveness process. As recently as Friday, the SBA put out some additional guidance, the interim final rule, on what the PPP forgiveness process will be and how you'll qualify for it. So I'm going to walk through both what the process is and then also some of the guidances that came out in that interim rule, as well as the application, which was published a couple of weeks ago. So obviously step one for this process is that you've received PPP funds. And what's important to note in this whole forgiveness process is the date that you receive the funds. And the SBA is using as the date you receive the funds, the date they were dispersed by your lender to you. So for instance, and I'm going to use throughout this, I'm going to use my laboratories in St. Croix and St. Thomas as an example. We received our funds on May 7th. So that was the day they hit our account. So that is one of the dates that we'll be talking about. Then the second step is that you expend your funds during the applicable period, and we'll talk about that in a second. And then after that, you're going to actually have to submit an application for forgiveness, which is on a 3-page form, along with some extra spreadsheets that you have to calculate to see how much forgiveness you qualify for. The actual process will be that you will submit that to your lender. They will have 60 days to review the application, and then SBA has an additional 30 days to approve and then pay the bank the forgiveness amount, which is how you will get your forgiveness, because the balance due will be lowered by the payment from the SBA. All right, so let's talk about what is eligible. And you know, if you've watched my other webinars on this, this part is a little bit of a review, but because it calculates into the forgiveness piece, I want to go through it again. Payroll expenses are defined as compensation not exceeding $15,385 per employee, which that number, by the way, comes from the fact that the cap for payment to each employee is $100,000. So $15,385 is the equivalent of 2 months of pay at $100,000 in the form of gross salary, gross wages, gross commissions, and gross tips. Vacation, parental, family, medical, or sick leave, except for leave that gets reimbursed under the Families First Act. And then allowances for separation or dismissal. It also covers the employer's contribution for group health, the employer's contribution for retirement plans, and payment of state and local taxes assessed on compensation of employees. It does not include your federal employment taxes, and it does not include wages paid to employees residing outside the U.S. and its territories, and it does not include wages that exceed $15,385 per employee. So if you are an independent contractor or sole proprietor, it's not always as easy to determine what qualifies. So payroll costs, the SBA has said, include wages, commissions, income, or net earnings from self-employment or similar compensation. So if you get a Schedule C for your self-employment, that would be the basis of where the revenue that you're reporting on Schedule C would be what you would be reporting for payroll cost. Compensation cannot exceed 8 weeks worth of 2019 compensation for any self-employed individual, capped at $15,385. So what that means is you basically look at your 2019 compensation, you look at 850 seconds of it, and that's the max you can pay yourself as a sole proprietor, independent contractor, and then that's capped at $15,385. So in other words, if you made less than $100,000, it's going to be something less than $15,385. If you made more than $100,000, you would cap it at $15,385. Okay, non-payroll expenses. Mortgage interest payments for the business on real or personal property, provided that the original debt was incurred before February 15th, 2020, and it's not the principal, just the interest. And similarly, rent or lease payments for the business on real or personal property, provided the lease was enforced before February 15th, 2020. And the real or personal property provision means that things like copier leases or equipment leases that you've had enforced prior to February 15, 2020 do qualify as a forgivable expense. The same is true on mortgage interest on real or personal property. If you have a mortgage interest issued in one of the personal property that you have in your business, the interest can be deducted as forgivable. The third category is utility payments. The SBA has clarified that utility payments mean electricity, gas, water, transportation, which is kind of an interesting category, and I'm not exactly sure what that means, and the new interim guidance didn't elucidate on that very much. Telephone or internet access, provided your service began before February 15th, 2020. Okay, so like I said, we're going to use as an example my labs just to try and show how this works. But the 8-week period, according to the rule, can be calculated either as 56 days beginning on the day your PPP loan was dispersed. So in my case, that would be May 7th. Or the 56 days beginning on the first day of the first pay period following the PPP loan disbursement. So what does that mean? So here's my example. So we got our funds on May 7th, 2020. Our normal payroll is payday every other Wednesday. Okay, so we're a bi-monthly payroll. So if if I choose to use, so the rule says you can use either dates. You can either use the 8 weeks immediately starting on the May 7th, or I could use this date that starts on the first day of the first full pay period after May 7th. So here's how that calculation would work. If I start on May 7th and you're supposed to include the day you receive the disbursement in the calculation, that would take me to July 1. In my case, that would mean I would have payroll covered for May 20th, June 3rd, June 17th, and July 1. Okay, and that assumes that payments are made when the checks are dispersed, or you authorize the ACH for direct deposit checks. If I was using the first day of the pay period after the disbursement, this is how it would look. 8 weeks from and including the first full day of the first full pay period after disbursement is May 17th for my business, just the way the payroll falls. So that would take it through July 11th. So if I use that date, which is what I'm going to use, May 20th, payrolls on May 20th, June 3rd, June 17th, July 1, as well as the payroll incurred from employee work from July 2nd to July 11th, if I make that payment on July 15th, so which is my next normal payroll. So basically, the rule says that pay is incurred on the day the employee does the work. So as long as the payroll in that last pay period, as long as the work was done prior to July 11th, which is my ending date of my qualifying 8 weeks, as long as I pay them the wages that they're due on my next regular pay date, which is July 15th, that would be included. So for me, using the 8 weeks from and including the first day of the first full pay period after disbursement as my quote qualifying period is actually going to make it easier for me to meet the 75% requirement that we'll talk about in a little bit. So I wish it was as simple as just saying, okay, those are the forgivable amounts, but that is not it's not always that simple. There are some things that will reduce the amount of forgiveness that you can get with your, one of which is reduced wages. So if your loan forgiveness amount will be reduced for each employee whose average pay, salary or hourly wage during the 8-week period, so that can be your qualifying period, whichever one you choose, is less than 75% of their average pay from January 1, 2020 to March 31st, 2020. So in my case, my qualifying period, like I said, will start on May 17th. So if my wages that I paid were less than 75% of the wages that my employees earned from January 1 to March 31st during May 17th to July 11th, then I would have my forgiveness reduced. The amount of reduction is based on the amount of reduction in pay. So the rule allows you to have up to 25% reduction, okay? So if my pay, if the pay I paid during the covered period is 70% of their average wage, January 1, 2020 to March 31st, 2020, the amount forgiven would be reduced by 5% because that's the difference between the 30% it was reduced and the 25% reduction that's permitted. So that calculation is per employee and is cumulative. So here's an example actually out of the rule. A borrower reduces full-time employee weekly salary from $1,000 per week during the reference period to $700 per week during the covered period. The employee continued to work on a full-time basis during the covered period with an FTE of 1. I'll talk about that in a minute. In this case, the first $250, or the 25%, is exempted from the reduction. The borrower seeking forgiveness would list $400 as the salary hourly wage reduction for that employee, which is simply the $50 from each week multiplied by 8 weeks. So that would be the amount, we'll talk about the forms in a minute, that you would list on the schedule showing for that employee. And you would do that for each employee that you had that had reduced wages. Okay, the other way loan forgiveness can be reduced is based on the reduced number of employees. So you're going to have to calculate the average number of full-time equivalent employees during your qualifying 8-week period and compare it to the average number of FTEs during a particular chosen reference period, and I'll talk about that in a second. The rule specifies that an FTE is 40 hours a week. So it doesn't matter if you treat your employees as having full-time at 35 hours, that would be considered less than full-time under the rule for purposes of forgiveness. So you calculate the reduction for that this way. You determine your base number of FTEs, and there's 2 alternatives you can use to calculate that. You can either use, you can either use February 15th to June 30th of 2019, or you can use January 1 to February 29th, 2020. If you're a seasonal employer, you can use a 12-week period between May 1st and September 15th of 2019 as well. But assuming most of us are not seasonal employers, you have to choose between the 2019 dates or the 2020 dates. In my case, I'm using the 2020 dates because I actually had fewer employees on those dates than I did in the 2019 date. And the reason, I'll show you why that's important in a minute. You divide the average number of employees during your covered period, which is your qualifying 8-week period, by this base number of FTEs. And the result is your percentage reduction. Now, I actually haven't lost employees, but just as an example, let's say that your base number of FTEs you were using the January 1 to February 29th, 2020 provision, and your base number of FTEs was 10. And then at the period during the qualifying 8 weeks, your number of employees was 8. Then you would have a 20% reduction in your payments, forgiveness payments, excuse me. So, but there are some safe harbors from these reduction rules. It will not be reduced if the employer reduced wages between February 15th and April 26th, but restored them by June 30th. And there will not be a reduction in forgiveness if by June 30th, the number of FTEs is equal to or greater than the number of FTEs on February 15th, 2020. So in other words, even if you lose employees in the interim, as long as by June 30th you've gotten them back, your FTE count will not count against you for reduction purposes. Okay, there are also a couple of exceptions. What do you do? And this is something that a lot of people have had issues with because of the generosity of the unemployment benefits. So here's how you look at it. If you have made a good faith written offer to rehire an employee that was rejected by the employee, that's not going to count against you. To qualify for that exception, you have to have the offer in writing. It has to match the hours and pay that they were making before their last time they were separated or had their hours reduced. You need to maintain the records documenting that offer and its rejection, and inform the applicable state unemployment insurance office of such employee's rejected offer of reemployment within 30 days of the employee's rejection. So you have to document that you've turned them into unemployment for refusing to come back to work, basically. The second one, you also get exceptions for employees that were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction in hours. These also have to be documented. So best process is to write a letter or do something you can put in your folder file that shows how these employees left employment. The reason that SBA is not counting these employees against you is that they believe this is a de minimis change and that not many employers will have this situation. I'm not exactly sure about that, having listened to people in my client base, but that is nonetheless what the SBA determined. So if FTEs are reduced, for purposes of getting a reduction, your employer does not also have to calculate reduced wages. So what that means is it's an either or thing for the forgiveness reduction. If you lose FTEs, then you're not also losing money based on the reduced wages that you've paid overall. So add to that the 75% rule. 75% rule is that 75% of the PPP funds must be used for payroll expenses. So your loan forgiveness can also be reduced if your non-payroll expenses, those that are eligible, exceed 25% of the total eligible expenses. So basically, to calculate that, the maximum eligible loan forgiveness is your payroll expense divided by 0.75. So if payroll expenses for the qualifying period equals 75,000, then no more than 100,000 of the total expenditures could be forgiven. So to summarize what I just went through, the loan forgiveness is going to equal the smallest of the following: your PPP amount, the maximum loan forgiveness amount based on expenditures during the qualified period, that's the 8 weeks, less reductions for reduced FTEs or wages, or the maximum loan forgiveness amount where the eligible payroll expense equals or exceeds 75% of the total forgiveness. So this sounds like a lot of Greek, but when you look at the schedules and the forms that are included in the forgiveness application, it's like a tax return in that it says, use number from line 6 to put on line 10 to calculate this, that, and the other. So you will have a way to walk through the calculation, and I'm sure that the lenders will be able to help people as they try and figure out what their forgiveness is. So what happens if you have an unforgiven portion of PPP? It becomes a loan at 1% interest with a 2-year term. That loan will be subject to payments, and the first payment will be due 6 months after funding. So in my example, I received funding on May 7th. If I have any portion that's not forgivable, my first payment on that loan amount would be due in November 2020, and I would have to pay off the entire loan by November 30th, 2022. There has also been, in the interim guidance that was issued on Friday, there's some specific answers to some questions that people had. One was compensation of owner employees. So if you're an owner, but you also pay yourself wages as an employee, the question was, could you increase the wages? Could you change your wages? What could you do? The wages that you pay yourself as an employee, owner employee, cannot exceed 8/52 of the 2019 compensation, including company paid benefits, or the $15,585, which is based on the $100,000 cap. So that's your answer there. There's a similar provision with regard to Schedule C compensation that says basically you have to cap it at 8/52 of your 2019 compensation. Okay, hazard pay or bonuses. For regular employees, that is covered up to the $100,000 annual pay per employee cap, so the $15,000 cap. It's also subject to owner-employee limitations, meaning that you really can't get hazard or bonus pay as an owner-employee. So, you know, that's unfortunate, but that's how they came down on that. They also clarified qualifying dates for non-payroll expenditures. Expenditures that are paid during the covered period, so that 8 weeks, whichever 8-week period you choose, or that are incurred during the covered period and paid on or before their next regular billing date, even if the billing date is after the covered period. So that's a lot of words. But what that means is, let's say your power bill runs from, like in my case, I got my money, let's say I'm using the May 17th through July 11th date. Let's say that my power bills come at the end of the month. So they come on May 28th, June 28th, and then I won't get another power bill until July 28th. I would be eligible to pay the June and July, the May and June power bills in full. And then I could also use the power bill in July as for the days or the percentage of the bill that related to the covered period. So in other words, I would be saying, okay, the first 11 days of July is equal to roughly a third of my monthly bill, and I could credit myself that amount as a qualifying expense, even if I pay that after the covered period. So I pay that bill on July 28th. The guidance confirmed that there are 2 ways to calculate FTEs. And this is important for those employers that have employees normally on a 35-hour schedule instead of a 40-hour-a-week schedule. You can choose to do it either way. I think if you're concerned about meeting your FTE, you're going to use the latter way. But the first way that is simpler just from a counting perspective is to say anybody who's less than 40 hours counts as 0.5 FTEs. Now you would use that, I think, if you have a whole bunch of employees that are less than 20 hours a week, because that would give you a benefit. If instead you have a whole bunch of employees that are 30 hours a week, which would be 0.75 FTEs, you would probably want to use the actual hours that they work and create an actual FTE number per employee. So in my example, 30 hours work divided by 40-hour work week is a 0.75 FTE. So if you have 10 employees that are working 20 hours or less, you would use 0.5. And if you have 10 employees that are working 30 to 40 hours, you would use the actual calculation. The other clarification that I wanted to mention relates to EIDL advances. So EIDL advances were those EIDL emergency funds that we applied for through the portal on the SBA website. You put in very minimal information, and then one day some amount between $0 and $10,000 showed up in your bank account. In my case in the lab, it was $10,000. What the guidance says is that those EIDL advances, which are by themselves forgivable, are actually going to be deducted from the forgivable amount offered by the SBA, which takes away their forgiveness, basically. So, so what that will mean is, let's say, going back to the example with you have $100,000, you have $75,000 in payroll, which would mean you could spend up to $25,000 on eligible expenses. You turn that in, but you also got a $10,000 advance. You would only get $90,000 of your $100,000 forgiven under the SBA, under the PPP program. So you need to understand that some people are holding that $10,000 and planning to just repay it as part of a prepayment, which is allowed for the PPP loan. Okay, so with all of that in mind, what do you have to show or give to the bank as part of your documentation? Most of the stuff in the SBA rule says you need to keep these documents. There are certain ones that have to be turned in, but these are the documents that they say they're going to accept as documenting the eligible payroll and non-payroll expenditures. So bank account statements or a third-party payroll service provider documenting the cash compensation paid to employees, your 941 tax filing for your federal tax, your employee tax return, your state quarterly wage reporting and unemployment insurance tax filings, payment receipts, cancel checks, or account statements documenting payment of employer contributions to employee health insurance and retirement plans. So in other words, for example, in my lab, we pay for 50% of health insurance costs. We get a statement every month that it covers the entire insurance costs, but we deduct 50% of that cost from each employee's wages. So we would only be able to use as a qualifying expense the 50% we paid. For non-payroll expenses, business mortgage interest payments, you need to show an amortization schedule and cancel checks or lender account statements starting from February 2020 and covering the 8-week period. The reason they ask for the statements from February 2020 is not because you can count from that date of the interest, but because there's a requirement in the rule that you must have already had the mortgage as of February 15th, 2020 for it to be qualifying. So the first statement is simply going to be to prove that you already had the mortgage in existence prior to February 15th, 2020. Then the checks that they will be concerned about for calculating the amount of the forgiveness are the checks that cover the 8-week qualifying period. Similarly, business rent and lease payments, a copy of the current lease and receipts or canceled checks from February 2020, again for the same reason, to show that you had the lease in place prior to February 15th, 2020, and then also covering the 8-week period. Finally, business utility payments, copies of invoices from February 2020 for the same reason, showing that you have these utilities already in place. And then the 8-week period, you need to show what you've actually paid for the qualifying 8-week period, as I described earlier with the little bit of extension on payments, for the time period that's within the 8-week period, but paid the first payment due date after that. So this right here is the link for the PPP interim final rule requirements. So everything that I just summarized is in this rule. It might be helpful to look at that, although I will tell you it's long. And then the other thing you need is, you can get on the SBA site, is the loan, through the same link, the forgiveness application. That document is 11 pages long. There's only 3 pages that are really the application. The rest is supporting information related to that. So don't be overwhelmed by the 11 pages. Look for the parts you actually have to fill out. And like I said, it is primarily a calculation type of document. I'm going to stop sharing right now and see if anybody has any questions. Whoops, there's a chat. No. So anyway, if nobody has any questions, that's really all I had to say today. If you have any questions or need some assistance in filling out your documentation, our law firm is helping our clients with that process. And also at Rising Tide, there are a number of our members who are going through the same process. So if you would like some, commiseration in the process, that is a place where you can come to do that as well. So anyway, thank you very much. And I look forward to seeing you in our next webinar. Bye-bye.